2020, 2021, actually the number of crypto accounts overtook demat accounts. Here is a generation that just started reading about finance, and suddenly, because all of them were at home and they've not experienced the consequences of risk, you go so quickly all in that 40 years of stock market and 2 years of crypto, and you end up having twice the amount of crypto accounts as compared to demat accounts. To grow in your career, I think for the first 5 years to grow in your career, your core skill matters. But after 5 years, where you end up depends on your management skills and not your core skills. Following the advice of your seniors or your managers actually don't work because the dynamics have changed. And we think we are doing the right steps, why are the results not coming? Ultimately, including me, most of us on YouTube, on social media, more than finance experts, we are entertainers in a lot of ways. No one has a lot of proven track record of making or
Wealth.
managing public money. No one has that. It's just that we reproduce knowledge that assumed to be boring in a more entertaining and in a more bite-sized way. In my school, we studied moral science in a way that in today's chapter we'll study about morality. In today's chapter we'll study about honesty. I never found that in Indian mythology. So I think Mahabharata, Ramayana, all of that. The Indian way of education is including everything in an interesting story, because probably the thought process what it is then that you retain more.
If there is one thing that I wish I had learned way before than I did, was to educate myself about finance, not to jump into any of the asset class just because it's in the hype. For instance, in 2020, I invested a lot into crypto, thinking that I'm going to miss out the opportunity to make a lot of money in the crypto bandwagon. And to cut the long story short, today my portfolio is down by 90%, and that's a huge loss that I incurred by investing in something out of sheer FOMO. And there are so many such bad financial decisions that we make in our life for several reasons. Either we operate from the FOMO mindset like I did, where we do not put a lot of time, efforts, and energy in understanding about that asset class. Or we get influenced by people when we follow the ship herd mentality when everyone else is doing it, so I should do it as well. Third, we don't also look at our personal needs on where our financial condition is and how we should really think about our money. And I wish I took up this journey of learning about finance way before than I did in my life. So in today's episode, I invited Pranjal Kamra, who is a finance creator who has been creating for a really, really long time, educating people on investments, stocks, and finance. He has got almost 5 million subscribers on his YouTube channel and also runs a company called Finology Ventures. In this episode, we discuss about what are some of the basic fundamental things that we need to keep in mind before putting our money. What are the kind of safety nets that we need to have in place before we even start our investment journey? How should we really think about our retirement? How should we go about planning finance as couple? And also, he shared something interesting which got my attention, which is if it's anything new and not proven, should you really get into it to have an early benefit, or the risks are higher? There's a lot that you can take back from this episode. I wish I had this kind of financial information really early on in my life. I hope you will take back a lot from this conversation and learn a lot. Let's get started. Welcome back to another episode of the Inspiring Talk podcast. I'm super excited to have Pranjal Kamra join us today. Pranjal, thank you so much.
Oh, thank you so much for having me here. I'm sure the kind of discussion we have had prior to recording this, I will be challenged today.
No, I try and do that. I try and kind of bring the different perspectives on each of the conversations. And this conversation, we are going to try and make this a wealth masterclass of sort for somebody who's listening and trying to figure out this whole world of finance. And I loved what you said before we started rolling, was that oftentimes people think finance is a separate entity and that is something that is different. And you said how it is integrated with with in our life, right? So maybe we can start by expanding a little bit on that one. And what do you mean when you say it's integrated? And also share why, how did we land here where finance is something secluded, or it's, it's not the integrated part.
I think, if we zoom out, I just think that's the probably, in my limited knowledge, that's the Western way of education. You isolate compounds in the study of medicine, and you isolate subjects, while trying to teach humans. So, for example, in my school, we studied moral science in a way that in today's chapter, we'll study about morality. In today's chapter, we'll study about honesty. I never found that in, Indian mythology. Panchtantra, you never even realize what moral values are you getting while reading those stories. So I think Mahabharata, Ramayana, all of that, the Indian way of education is including everything in an interesting story, because probably the thought process what it is then that you retain more. So and in the same lines, I tried a lot of self-help books, and somehow whatever I read did not stick with me in a few months. Whereas if you read a few interesting stories, it sticks with you. So I think finance as a separate field of study, it's not that just it happened just with finance, but it's the Western way of education, probably where you study subjects in isolation. I think specifically for finance, because so for example, health. Not everyone in the family needs to be absolutely aware of what herbs or what medicines do what. If you have a family doctor, he or she will take care of it. But when it comes to finance, not just one member in the family, but every individual in the family needs to understand the basics of finance. So because it's so important, not for one family, one extended family, but every individual to learn, it becomes a very core part of your life. And it becomes something very indispensable, and therefore it should be taught not in isolation but along with your daily learning. So we tell, during our growing up days, I remember my parents teaching me the importance of telling the truth, importance of not harming anyone, but very rarely would I hear how to use money.
Yeah.
When it comes to money, they would say you would get 10 rupees a month, 10 rupees a week, and things like that, and you can do whatever you want.
Yeah.
So all we are taught is probably budgeting,
Budgeting.
but nothing beyond
Beyond that. That's true.
And ultimately, whatever financial decisions we take impacts our lives, our families' lives, and everyone is impacted. And those impacts are sometimes irreversible and very, very long term. So I think, if finance is taught at a very young age, say when you're 5-year-old, you're 10-year-old, is when your finance learnings will automatically be included in the stories that parents tell to their children. The simple reason finance became isolated from other subjects is because we are taught finance from high school, not from primary school or middle school. Because the way of teaching in primary schools is very different. It's all inclusive.
Yeah.
So I think the problem is that we don't teach finance early enough. If we just start doing it, it will be more inclusive.
Yeah, that's really interesting. And because we didn't get that kind of knowledge when we were school, and I remember pretty much like what you said, right? The best that I would know is the budgeting bit of it. And I tried my hands a little bit on trying to sell something, buy from somewhere and try and sell it to my friends and so on and so forth. Maybe a bit of understanding of like you get somewhere, and I understood a bit of concept of profit and loss. But I mean, that's pretty much it, right? So nothing where you got this wisdom or knowledge as a practice, right? So because of which, what are some of the things that you really think the association that people build with money, which is negatively impacting the wealth creation process? So we'll start by talking about mindset, and then we'll get into the whole process of wealth generation, as a follow-up to, once you've covered the mindset, like what are the kind of association that we started generating for the wealth because of the upbringing that we had as a culture.
Right. So, and this is broader than personal finance, but I think one misconception or one wrong notion about money that we all develop, and it's very pervasive
Yeah.
in the sense that, we always measure how well we are utilizing money in terms of, say you mentioned in your growing up days, you used to sell things and, make money. And always the focus would be, at what price did you buy the material
Yeah.
and at what price did you sell.
True.
So what was your profit margin?
Profit
You know,
margin.
we are tuned to think in terms of money, be it
Mm.
our personal money or business, that it's about profit and loss.
Mm.
You know, how much you earn, how much, at what price did you buy and at what price did you sell. So it's always profit margin.
Mm.
But the basic fundamental of money is not profit margin per unit.
Mm.
It's actually return on capital.
Mm.
Just to give you an example, and if we just start thinking this way, we'll manage our finances well and we'll get better in our profession and also our business. Just to give you an example, so there are two people, person A, person B, both buy pencils, say 10 pencils worth 10 rupees each. So at the start of the day, they both invested 100 rupees. Now, person A decided he wants to sell pencils at a premium. So the pencil that he bought at 10 rupees, he started selling at say 15 rupees. So he earned 5 rupees per pencil.
Yeah.
By the end of the day, he sells his 10 pencils and he has 150 rupees with him. So on 100 rupees, he made 50 rupees.
Yeah.
And you know, we would measure his performance by that. He sold 10 pencils, 5 per pencil, he made 50 rupees. So on an investment of 100 rupees in the beginning, he earned 50 rupees, 5 rupees per pencil, 50% margin. There's this another person who buys the same pencils, 10 pencils at 10 rupees each, but he starts selling at 11 rupees. Therefore, he ends up selling more of it. You know, people are buying more. The other person is selling at 15. I'm getting here at 11. So people buy more. By the end of the day, he's able to sell 100 pencils. He earns only 1 rupee per pencil, but he sells 100 of them. And in the end of the day, he had 100 rupees on top of the 100 he invested. So his return on capital was actually 100%. But, you know, we measure performance by he earns 5 rupees per pencil and he earns 1 rupee per pencil. And we measure everything in terms of P&L. Whereas return on capital or return on investment is much more important than everyday P&L. Just to give you an example of Walmart, you know, one of the biggest corporations of the world, its profit margin is 0.5%. That 0.5% actually allows them to sell a lot of stuff.
Yeah.
So they are earning 0.5 on a lot of transactions. So I think, you know, I don't know. During my childhood, all I could think, I did a lot of, child-friendly businesses like renting comic books, renting game CDs and things like that. And even I always thought that way. How much did I earn per unit of transaction? But that's such a wrong way to think about it. Ultimately, all you are concerned about is this much money I put in, how much money did I make on the money I put in? Because ultimately, you want your money to work for you. So you also measure performance on how much incremental return you made on money, on your money. That's how hard your money worked. So you also have to measure, it's not about how hard you work. It's about how hard you made your money work. If money is an object that doesn't get tired, you want your money to work really, really hard for you. So I think that's one difference that I think a lot of businessmen don't understand, professionals don't understand, and salaried people definitely don't understand.
That's really interesting. Now, I think that's a great way to look at it, right? And also in the place like India where we have crazy number of people here, right? And I think the game of volume, if you look at, and this is something that I was talking to, having conversation this morning. The Amazon Prime subscription in India cost 1,000 rupees, and in UK it cost 10,000 rupees.
Right.
A year.
Right.
And I don't know the numbers, but I'm assuming that Prime probably would make way more here in India than in UK that they will ever, because the sheer volume of people that we have. Like I said, I haven't looked at the number, what that number is like, but because the number of people that we have, right, they would make way more than that. So that's one aspect of it, that we do not look at return on the on our investment. So, and also like when it comes to making money, what are some of the like biggest disbeliefs or biggest like mindset blocks that you think we do have, a lot of people that you have encountered, and the people who are working at job, or the people who are mostly like let's say working professional or salaried people, and also like business owners to some extent, like from the mindset perspective, what do you feel that they just don't understand?
I think, we have this high sense of entitlement.
Mm-hmm.
That, just because I was always the topper of my class,
Mm.
or I cracked DU or IIT or IIM, I deserve this much.
Mm.
We need to understand that, for example, 12th class, say 12th class, every year in CBSE, roughly 12 to 13 lakh students appear for the CBSE 12th class exam. Probably 5 lakh each of those would be from commerce, and 5 lakh science, and the remaining is from arts. So imagine this, and this is really terrifying if we understand this. Every year, 5 lakh students are studying the exact same poems, plays, and stories that I am studying. So basically, we are preparing 5 lakh clones every year. And your working life is roughly 30, 35 years. So you multiply 5 lakh by 30, 35 times, and that is the number of people who have studied the same thing throughout their school.
Mm.
And then you want your employer to consider you as different.
Mm.
How on earth will he or she be able to consider you as different?
Powerful that is.
Someone might have scored 60% in it, someone might have scored 80%, but essentially they've all studied the same
The
thing.
same thing. Yeah.
So no matter how good you get at it, there are 10 times more people who know 80-90% of what you know. So why should you be valued higher?
Mm-hmm.
So, I'm a big believer in interdisciplinary learning.
Mm.
I think to a man with a hammer, everything looks like a nail,
Mhm.
which is why it's extremely important that a science student learns about commerce and arts, as commerce students learns about the other two disciplines, because ultimately, you never know which mental model helps you in which, corner of life. So I think one way to get ahead is to learn something about all the disciplines:
Mhm.
psychology, sociology, political science, economics. If you know all of that a little bit, at least the basics, how unfortunate this is that a science student probably doesn't know 5 basic principles of economics,
Mm.
and an economic student does not understand 5 basic principles of physics. That really limits our cognitive ability and our ability to take decisions, because ultimately, to grow in your career, I think for the first 5 years to grow in your career, your core skill matters.
Mm.
But after 5 years, where you end up depends on your management skills and not your core skill.
Mm.
So how will you end up improving your management skills? By reading, about various aspects. That is when you can handle various people, handle different situations, and you become an overall better manager.
Mm. I think that's a really, really powerful thought on the way, you said like, hey, you know what, I'm a topper or whatever, but ultimately we've learned the same thing that 100 other people have learned or thousands of people have learned. And it also is about like, if you want to make more, then you have to figure out like, what is it that I know that there's 95% of the other people, if I
See, I
want
think
to.
the only way to earn more
Yeah.
is to become, in a job setting I'm talking
Yeah.
about,
Yeah.
is to become irreplaceable.
Mm.
The only way as an employer I'm going to pay you more than the market standard is if I cannot replace you.
Mm.
So how do you make yourself irreplaceable? Simply by building various mental models. How will you do it? By reading about various disciplines. So it's very, very simple if we think like that.
Mm.
One thing I've also observed, when you're trying to grow in your own industry,
Mm.
by trying to do things which are supposedly you're supposed to do in order to grow in your industry. So, in every industry, there are your seniors
Mm.
who would tell you do this, this, and you'll end up doing
Yeah.
well.
Yeah.
But I think that feedback that you get from your managers or seniors, that do these 3 steps and you'll do well, that feedback or those suggestions are often delayed.
Mm.
Just to give you an example, 4 years ago I started hiring, and there was this girl that we hired so she joined us as an intern, and the only reason we took her as an intern was that she had cleared CFA level 1.
Mm.
And back then, 4 years ago, it was really tough to find someone who had cleared even CFA level 1 in Raipur. Now she's almost completed with her CFA, and I know it for a fact that for the next 10 years, people would look up to her in her family. She's doing really well at our company as well, and I think she is the first female person to work in her family. So a lot of people in her family, her cousins, look up to her, and for the next 10 years they would look up to her. And if she continues telling them
Yeah.
that you should do CFA,
Mm.
I did CFA level 1, and I got a good job. And from then everything went well. But as a recruiter, I know the reality that today, if you are CFA level 1, they're so easily available, we don't even look at them. You need to be at least CFA level 2 to be an intern at our company, because people like her,
It's very dynamic and changing super
very
fast.
quickly.
Yeah.
And people like her, they are such big role models that
Yeah.
seeing her, 100 more people end up doing CFA.
True.
So by the time you realize that, okay, she might have followed those steps and those turned out to be really well, times were different and
Yeah.
times changed drastically in 5 years. So often, I think, following the advice of your seniors or your managers actually don't work, because the dynamics have changed. And we think we are doing the right steps, why are the results not coming?
Yeah.
Because it's delayed.
That's really interesting. So what's the kind of difference that you see in, let's say, the understanding of money in the millennials versus the Gen Z? Do you see any difference in how both of these different generation sort of approach money?
So there's one difference that I clearly notice is that millennials started learning about money at a slightly older age, but Gen Z, they're probably learning about money 10 years of age, 12 years of age. So this is the first generation that's actually learning about finance in the pre-teens
Yeah.
age group. That has never happened. What are the consequences of it? I don't really know. We have to wait for 5 years and see the consequences of it. But I see, this crypto boom that happened in the last couple of years probably happened because a lot of youngsters were coming in, and all they had was digital learning.
And also, like when Zomato IPO happened, right? The major investor, a lot of the individual
Sure.
investors were the first time investors.
Sure.
You wouldn't have imagined that like 3 years back or 5 years back, let's say.
So the reason I did not bring IPOs up is, I think in all bull markets last 30 years since 90s, this is one common trend, that if IPOs are doing well, a lot of fresh investors come in, a lot of demat accounts are opened. But I think suddenly, in 2020, 2021, actually the number of crypto accounts overtook demat accounts. This is because of a generational shift. That here is a generation that just started reading about finance, and suddenly, because all of them were at home and they've not experienced the consequences of risk, and because naturally this is an age group where you're attracted to the latest and the most hyped asset class.
Hyped asset class, yeah.
You go so quickly all in that 40 years of stock market and 2 years of crypto, and you end up having twice the amount of crypto accounts as compared to demat account. So that is one thing that clearly happened because of Gen Z and younger millennials suddenly thinking, okay, tech, this is the way to go. So never before this has happened, that a new asset class that has emerged probably in the last 5 years in India specifically. Yeah. In the last 5 years, an asset class emerges and becomes a bigger asset class compared to stock market. Usually a new asset class would have been viewed with huge suspicion.
Yep.
It would take 10 years to mature, and then the adoption curve will be slower. This suddenly an asset class emerging and becoming the biggest, I think this happened because of this younger generation. So I don't know what the consequences will be.
So there are like both sides to this, right? I mean, because the adoption maybe, also because the times that we're living at, right? Like, I mean, maybe if it took 40 years for this stock as a asset class to develop, but we're living in the time which is where things are moving at like a rapid scale in the tech, and like whatever you look, right, the way things are moving, where you and I would have thought that, hey, you know what, I think this is something that's going to take like at least 5 to 10 years is happening in like a year's time, with the AI and all the stuff, right? And then maybe that's also the factor to this, like,
see, I would have understood it if it was comparatively easier to invest in cryptos, and stock market still involved a lot of paperwork. It's equally easy to invest in the stock market, and stock market has certain.
So you think that it's more of a marketing and the hype that it's been generated around it?
It's simply because it's very techy, it's very cool, and that is what pre-teens or teens relate with. It could be fashion, it could be food, it could be culture, anything. But I think anything that's new, the younger you are, the more acceptable you are, because you don't have anchoring of the past technology or the past era. You enter this ecosystem now, and whatever is the coolest or the most hyped, you think that's the base. You're not anchored to the past. So naturally, younger people are more tuned to accepting change because they're not anchored from the past. So I think one thing that I saw is the only reason this could have became twice the size in terms of number of accounts. Of course, total investment is much less because the younger generation is investing, so their ticket size is lower. But in terms of number of accounts, is because the younger you are, the more risk friendly you are. You're willing to take more amount of risk because you don't understand the consequences of that. Now, when cryptos are down 80-90%,
Yeah.
I'm sure they understand. So in terms of, if I say learning curve, it hasn't changed. I think our father's generation learned this way, taking excessive risk, understanding the consequences, becoming risk averse. Millennials understood this way, and Gen Z is also understanding this way. It's just and it's unfortunate that they exposed themselves to cryptos, suffered more loss than previous generations because stock markets don't go down 80-90% that often. And because of this, stock market and cryptos both are now painted with the same brush in their minds. So that's a little unfortunate.
No, that's a really interesting perspective right there. So we're talking about the mindset of the people and the skills and stuff like that, right? So for somebody to make more money, what are the things that they need to understand fundamentally? Like one thing that we said, like, hey, you don't look at just profit and loss, P&L. Second thing that we said, like, hey, how you are differentiating from hundreds of other people who have read the same thing that you have read, that's right. So what else?
So in terms of, you're talking about how to get more from your investments, or
No,
in general?
in general, like for me to make more money, here are the few things that you need to know. Like
Right.
one, we said, like, P&L. Another is like skills. What else?
One core thing. So this is, first I'll talk about active income and then I'll talk about passive,
Sure.
and collectively you have both ways. So one, no matter you're self-employed, employed, or in a business, thousands of years of human civilization, we have certain ground rules, and we need to respect and learn about those ground rules. I think a lot of times someone, and this is true for me as well, I manage a company of 50-55 people, and if you ask me, do I know the 10 ground rules of how to be a decent CEO? Probably I don't. I know 4 or 5 rules, but
Yeah.
I don't always act using those mental models. So I think whatever you are doing, I really like how Dhoni and Sehwag would break down cricket, that ultimately it's about bat hitting the ball. It's, if your head is clear, most of the times you'll end up doing that, because if you have reached that level, obviously you have the skill. Now it's about going back to the basics and keeping your mind clear. And I think that's true for what we do in our lives. Sometimes we overcomplicate things. We figure out great hacks that work for short term but don't work in the long run. Because what are most hacks? Say finance hacks, business hacks, they are information arbitrage. They work for few months, weeks, everyone figures that out and it stops working. But we don't pay enough attention to ground rules. As a tech engineer, how am I supposed to learn new languages? What is the most efficient way to learn a new language in the least possible time? So what would I do if I'm trying to be that? I will try to find probably the similarities between every different tech language. Okay, these are the 5 ground rules on which every language works. So I'm very clear on them. And every time then I start learning a new language, I don't start from scratch. I know that every new language is at least 30-40% similar to the previous one, and these are the similarities. So I always start 40% ahead. I don't start from scratch because I'm aware of the ground rules. So I think in our discipline, if we are aware of the ground rules, we learn quicker, it's more efficient, and we don't feel lost when we are getting started. And this is just about in your particular field. I think there are a few ground rules in life as well, as a professional as well, as a family person as well, as a friend as well. So I think in each dimensions of our life, if we are clear around our ground rules and the non-negotiables, when to say no, I think life becomes much easier. Also, now coming to both something that works in active and passive income, and this is particularly about money. In general, if you are investing, if you are saving, or if you are taking loans, all three aspects, lending, insurance, investments, boring is good. If someone brings you a fancy insurance, it has to be bad. It's just a new way for them to make more money because the regulator has recently probably reduced margins, and therefore that previous product is not lucrative enough. So they, find a way around the regulators, new regulations, and bring in a fancy product. If it's fancy, if it's new, it's not good. It's true for insurance. It's true for investments. Cryptos are an example. It's true for lending. Say buy now, pay later cards are an example.
Yeah.
You think that you're using a credit card, you end up taking multiple personal loans. It
Yeah.
impacts your CIBIL. Anything that's new, IPOs are another example.
Mm.
If there are 5,000 companies already listed and this new kid on the block is up for sale, before adopting that new kid, I have to convince myself, how is this new kid better than the 5,000 previous ones already available?
Mm.
Just because of PR, just
Mhm.
because a lot of people are getting a lot of money to talk about that new thing.
Mm.
It's the same with NFOs. It's the same with new residential or commercial real estate properties. You want to talk about the new thing because a lot of people are paying for that. Because a lot of money is already on the table. A lot of money has already gone into building it. And the only way to recover is to sell it aggressively.
Mm.
So this is not in about investment. This is about how you make your purchasing decisions in your everyday life.
Mm.
Why would you buy the latest shoes that Nike has launched and is promoting aggressively? Next year, a new technology would come and the previous shoe will be at a 50% discount. It's the same with iPhone Pros.
Mm.
If it's a 16,000 rupees more expensive in US, why is it 50,000 rupees more expensive in India? You could probably buy an iPhone 13 Pro or you could buy an iPhone 14. So most new things, the latest things, if you purchase, usually it's a bad decision, not just financially, but also because the product is not well reviewed. You
Mm.
don't have any user review or user feedback. So often a lot of first generation car models, they end up with a lot of tech bugs.
Mm.
You realize that there's some rattling here, airbags are not inflating, average is down, and when the second updated model comes, most of those problems are ironed out. So in general, in life, if you stay away from the very latest innovation, you're going to do well than you currently are.
Mm. But also, I think there's a lot of pressure to be the first one, right? I mean, whatever that is, to adopt the first one, be ahead of the curve,
Right.
if I may. Where it's also like sometimes it also works in your favor. Like if you looked at the people who probably got on the whole crypto ahead of the curve, like when nobody was talking, probably made the most money. Or maybe not, one can always argue that. But like if you generally look at somebody who probably got on that wave early on versus it became like a mass thing.
Right. See, there will always be examples and
Yeah.
incidents where being ahead of everyone worked.
Yeah.
But as a process,
Mm.
when you are looking to build a
There's no
process,
shortcut. Like if you're thinking of this as like a overnight thing, then
Correct.
then that's not how
Correct.
you should be thinking, probably.
Correct.
Yeah.
So if you're looking to build a process
Mm.
that repeatedly works for you
Yeah.
throughout your life and without exposing yourself to risk,
Mhm.
then I wouldn't be the first mover in any of the categories.
Yeah.
Also, we need to understand that the people who really made money in cryptos were the ones who were really, really into it. As in,
Mhm.
probably they were developing the ecosystem.
Mm.
So they were insiders. They were not casual people trying to hop on to someone's invention and making money out of it.
Mm.
They were actually entrepreneurs building the ecosystem. So the rewards that they got were actually rewards for entrepreneurship, not
Mm.
investments.
Mm.
And entrepreneurship is always more rewarding in
Mm.
general because the risks are higher.
Mm.
So I think that wouldn't be the right example because most of
Mm.
them were actually entrepreneurs
Mm.
and they knew probably 100 times more than we did.
We did,
So I
yeah.
think another ground rule this brings me is, and again, in general, in life, but specifically in investing, never venture out of your comfort. Never venture out of what you know.
Mm.
In the sense that if I don't know, so in stock market, I've seen this a lot, specifically with the younger generation. They would the first stock, and when I do these physical seminars, I ask this: then how many of you own, so say there are 500 people, and I would ask how many of you own Infosys, and probably half the hands would go up. And then I asked them, how many of you use products by Infosys, any product of Infosys? No hand. Or probably if there is a bank employee, a couple of hands go up. And then I asked them, how many of you own shares of Bata? No hand goes up. And I asked them, how many of you have at least one pair of footwear in your household made by Bata? Almost all hands go up. So think about this. We don't invest in what's obvious, in what we are using as a consumer.
Yeah.
But we want to always go towards something that promises stars. So in fact, when I ask, a lot of people have invested in Tesla, and no one owns Tesla in India, in that crowd at least. So why go and buy Tesla when you don't know about it as a consumer?
Yeah.
So I think, to this, sometimes because, and there's a reason behind why this happens. Because say someone is a doctor. Now, and working in a hospital, because of working in an industry for a certain number of years, for a certain number of hours, they understand and they know everything that's wrong in that industry. And that makes us sort of unlike that industry. That makes us deflect that industry. That if I ask a doctor, how many pharma stocks do you own? I don't invest in pharma stocks. You know what kinds of things happen. What commissions are exchanged in hospitals and things like that. I don't invest in that. And they know nothing about IT. I'm sure equal malpractices happen in the IT industry as well.
That's true.
It's our ignorance which makes us think that those industries are better. But we'll always end up doing better if we stick to what we know. Because, ultimately, if no matter how much annual reports I study, I cannot know more than a hospital than a doctor. But a doctor would never invest in a hospital. How unfortunate is that? And a doctor would always invest in an IT company. And the vice versa is also true.
Yeah. No, that's really interesting. And, a moment back you were talking about learning, and which reminded me of, I had a, chat with Naveen Jain, who is a billionaire. And he said one of the important skill that you can really pick up is learning how to learn about things. When you learn how to learn, I think that's like, that's the way, like you said, like knowing the ground rules and setting the foundation so that you are ahead of most of the people, because you have the grasp of the vocabulary of a lot of, stuff generally, right? So when you have the vocab of a lot of things, then it becomes much easier for you to study what's new, and, the research paper or whatever the studies that are coming out, so that you then are a little ahead in terms of learning. So from that, like for somebody who, let's say, maybe have invested, like maybe downloaded small case or maybe grow or whatever, and then just, okay, I see that these guys have curated this, let me put my money and
small
let's
case is new, by the way.
Yeah. So yeah, whatever that is, right? So okay, because I don't understand mutual funds, I don't understand this, and let me just, like, it looks like interesting way, because I don't have to think about it, there are people thinking for me, or maybe just put it out there. Now, where should one begin the journey of understanding managing their money? Like, where does it begin? Like, what is the first step? Okay, now let's say, Pranjal, I have never ever invested anything. I look at now, getting into this whole personal finance management, other than like I make money through my job, through my business, whatever that is. X amount comes to my bank. X minus Y is my monthly expense, and I have Z amount that I have as a spare, which I can probably invest or whatever. So how should like one really then start if somebody has never done anything like that?
Right. So, we'll start with what is the amount that you should invest. Probably that's the one question. So I think in general, if you can manage, try and invest at least 20% of your monthly income, whatever that is. If the higher, the better, but aim for 20% at least. So that's a good way to start. And then, keeping it very, very simple is important, because, if you try to invest in something which you're not comfortable with, one, you'll invest less than what you can because you're not comfortable. And second, you'll exit earlier. And, ultimately, whether that instrument offers you 15% or 20% is not important. What's important is if inflation is 5-6%, whether you are earning more than 6% or not, and whether you can stay invested for 10 years or not. So if you find an instrument that after all the taxes gives you a return of more than 6%, and you're so comfortable with that instrument that you can stay invested for 10-20 years, that's the right investment for you, and that's the right instrument. So now let's figure out what are those instruments. I think for Indians, gold is one such instrument which will easily defeat inflation. And thankfully, one instrument called the sovereign gold bond is something that actually gives you 2.5% of annual return on your gold investments. So basically, it gives you capital appreciation of gold, which is historically been 10 to 12%, and it also gives you 2.5% of interest on your investment. So that it gives you returns of potentially mutual funds and return and annual dividends of your savings account. And on top of that, if you buy it from a demat account from the stock market, you often get it at a 4-5% discount as well. So imagine buying gold at a 5% discount. No making charges, no GST. It has a maturity of 8 years. You can sell it before that in the stock market. So because you're selling before maturity is why you need to sell it at a 4-5% discount. And if you're a buyer, you get that discount. But if you don't and you hold it for 8 years, RBI buys it back from you, and any income that you make from that capital appreciation is also tax exempt. So you're buying it cheaper, you're not paying GST, no transaction taxes, and when it's mature, you're also not paying any capital gains tax. So I think that is one blind instrument that's good for everyone. And if you add 2.5% on the 11-12%, it gives you as good as returns as mutual funds and stocks. And gold is of course less risky than stocks because there's no country risk involved. If tomorrow something bad happens in India, gold prices are not going to fall drastically.
Yeah.
But stock market will crash.
True.
So it's less riskier, but it gives you equal returns, which makes it a great investment that everyone should go for. And gold is naturally something you will be comfortable and you will hold on. And you will not be reluctant to invest, as per your capacity. So no matter how much I brag about how good stocks and mutual funds are, the truth is if you have 1 crore to invest, you'll probably end up investing 5 lakh rupees. So no matter how good those stocks and mutual funds perform, because you couldn't allocate money in it, you will not create wealth. So first question to ask yourself is, forget which asset class gives how much return. Which asset class are you comfortable with? Because be it real estate, gold, or stocks, everyone in the long run is going to defeat inflation if you do it well. And if you buy really bad real estate or really bad mutual funds or stocks, you're not going to do it.
True.
But gold is one where your decision making is irrelevant. You buy gold and it's going to perform the same way for the entire world. So that is why I really like it. And second, most Indians are comfortable with real estate.
So what percent of the investment do you usually allocate for the gold?
As a finance influencer, specifically talking about stocks and mutual funds, most of my wealth is actually parked in real estate.
Okay.
Yeah, so this is ironic, but I'll tell you how that happened actually. So coming from a middle class background, my parents never had a house. My grandparents never in their own house, and there was this constant discussion and regrets about past where we were getting a good deal. वो घर, that home was available for 10
That's more of
lakhs and we
emotional,
missed it.
yeah.
Things like that. And I've always heard my parents and grandparents talk about khud ka ghar. So probably that is something that was ingrained from childhood. So I wanted to give that to them. And I realized that once they realized how great it is to live in their own house is when my family realized we should have a farmhouse as well. We should have a office as well, and it never ends.
Yeah.
So and very honestly, my finances, my father looks after it mostly. because he was always into it. He in fact he taught me a lot about money. It's just that he was into certain businesses where he did not end up with a lot of spare money to be able to make those investment decisions. But now that he sees that I have cash flow, he thinks now it's his time to take out the money manager and manage that. So he keeps hunting for. So he would ask me two things: what's the balance in your savings account? I'll tell Papa this much I have. Okay, I have these real estate options in this budget, and that is how it ends up going. So I think
Yeah.
70-75% of my net worth is actually
Wow.
is in real estate.
Hmm.
But as I said,
Hmm.
um,
Like you said, like that's what you are comfortable with, right? And it's not
that's
that
what my father is comfortable
yeah.
with.
Yeah.
But even that works. Probably my returns would be 2-3% less.
Hmm.
But on the contrary, when I ask myself, I find logic in this that okay, my 70-75% of net worth is in real estate. But suppose that was not the case. Would I have been comfortable investing that large quantum of money in the stocks?
Hmm.
Probably I wouldn't have done it.
Hmm.
So in a way, even if I'm earning 2% less, I'm allocating 30-40% more capital.
Hmm.
If you allocate 30% more capital at 2% less, you are ending up still much better than you would have.
Hmm.
It's still better.
Hmm.
So identify the asset class you are comfortable with. And if it gives you 10% pre-tax returns or 6-7% post-tax returns, any asset class above it
Hmm.
is a great asset class. Stay invested. Delete the app through which you have invested, and forget about it.
Hmm.
And it's going to do well.
Hmm. Hmm. No, I think what I also took from what you've shared is the standard template that, oh, you know what, if you have 100 rupees to invest, 20 rupees should go on mutual fund, 30 on
Never works.
stock, and
Looks great.
yeah,
Never
looks
works.
great.
Never
But yeah,
works.
I think because then you need to know about all of this, right? You need to like educate yourself of all of this.
Also,
Hmm.
this rule is great,
Hmm.
but this rule should be in the context of this is how you should end up.
Hmm.
So in your 30-35 years of earning,
Yeah.
when you're nearing retirement,
Hmm.
this is how your portfolio should look like.
Hmm.
30% real estate, 30% gold, 40% mutual fund and stocks. This is what it should eventually look like.
Hmm.
If someone is earning 50,000, 1 lakh rupees, you're saving 20,000, 15,000, you'll not end up investing 5,000 in gold, 5,000 in real estate, 5,000 in mutual fund. It just doesn't work that way.
Yep.
So, and also, when you're young, newly married, probably living in a rented apartment, looking to buy your own apartment or a house, your priority is different. Your
Hmm.
priority is to get a home for your family.
True.
So in the beginning of your career, this allocation will look skewed, and which is okay.
Hmm.
Until you have this realization that okay, abhi I have bought 2 properties. For the next 10 years, I'll not buy any other real estate. I'll invest in gold and stocks.
Hmm.
And after 15-20 years, you will realize that okay, if you follow that discipline, you will end up with this rule 30, 40, 30, somewhere around that. But it's not essential to follow that every month, every year. That's not how practical life works.
Hmm.
Because you might be very, very disciplined and you might follow all the financial rules, but you're not going to enjoy gold every day. You're not going to enjoy stocks and mutual funds every day. But your family is going to enjoy real estate from the day you buy it. So even if it gives you 2% lesser returns, but you're also consuming it, that also has value. Now, whether that value is 2% or not is up to you. But I don't believe in these strict financial scientific rules. I think they ignore the practical reality.
Hmm. And also the emotional side of it.
Absolutely.
Because
All
we
of
are
that has value.
highly emotional
Sure.
people.
And see, Indians, I think a lot of Indians actually started making money after the liberalization, privatization, globalization. So last 25-30 years. So I think our parents' generation is the first generation for a lot of majority of Indian families that actually started making money. 30-40 years ago, 60-70% of us were below poverty line. So we were really poor. So when an entire country is poor and is emerging out of that poverty, it has some natural inclination towards instruments that give them that security and that uplift their lifestyle in a daily way. So no matter how much you tell them that invest in stocks and mutual funds and this should be the allocation, it doesn't impact their life on an everyday basis. So if real estate gives you 2% less but improves your life, I think it's a right balance between enjoying it now and saving for the future. It's the perfect balance. And that balance has certain value.
So what I hear you say is whatever the amount that you have, then you can look at like, okay, this is the kind of ratio that eventually down the line
Correct.
I'll want like
Correct.
maybe 20% of my wealth in gold or 40 in
Sure.
whatever, 30 in
Sure.
whatever way that you want to distribute that.
Sure.
But right now, maybe then you focus on one
Correct.
and maybe remaining of it a bit here and there.
Oh, absolutely.
And then you'd go about doing that and eventually maybe, keep on heading towards the kind of ratio that you would want.
Right.
And the reason you say that is because if you split small amount to 5 different things, then it's not substantial
Sure.
return that you get. Is that what you
Yeah.
trying to
Right.
say? Yeah.
That's one. And I think, say if you're saving 10,000 and you're allocating 2,000 to each of those instruments.
Yeah.
After 1 year, you look back, okay, I invested 20,000 rupees. I'm earning probably 2,000 rupees in it. You get demotivated because the result after a certain number of years don't look drastic enough. And sometimes after certain intervals, results is what keeps you going.
True.
Whereas, if you buy property, a
Yeah.
couple of advantages happen. One, probably you take home loan or whatever happens, and because real estate is not easy to sell, you end up with a lot of money actually being parked. Otherwise, in any other asset class, if you would have invested, you would have taken out money, enjoyed the small profits, and used it somewhere else. So because your money was parked and you can't sell and buy real estate every day, your money is still there. It's also a great saving instrument. So it's an FD that's giving you 12%. Wouldn't you take that FD? It's a great FD because it's not easy to break. Similarly, if you buy physical jewelry, now it might have GST, it might have making charges, but selling physical jewelry is against the dignity of an Indian family. You might sell sovereign gold bond tomorrow.
Yeah.
You find that you read somewhere that gold prices could crash. The day you read gold prices could crash, you would sell sovereign gold bonds. You won't sell your jewelry. So that stickiness has value. So we need to understand the kind of person. If someone is very, very disciplined and these things don't, impact his investment behavior, you could stick with stocks and mutual funds and ups and downs for the next 20 years. Great. Stocks and mutual funds are a great investment. But most individuals are not like that. We have to. So, even last 10 years, I am in this field, but I don't invest in normal mutual funds that I can sell tomorrow. I invest all my mutual fund investment is actually in tax saving mutual funds. And the maximum tax benefit that I'm going to get is on 1.5 lakhs. But I invest lakhs of rupees in tax saving mutual funds simply because I cannot exit for the next 3 years. So I make it difficult for myself to exit. So I don't trust myself even after 10 years of reading finance, understanding finance, because if you put yourself in a situation where you are more likely to act irrationally, you will act irrationally. The right way to go about is don't put yourself in those situations. So by investing in tax saving mutual funds, I'm never putting myself in a situation where by reading a headline I might sell. I can't sell.
No, I think that's a great tip right there. Like where you put in something and then like let it do the work, because
Right.
you can't be very emotional about what's going on market and like, okay, let me be very you take decision like with the market sentiment, right? And
Right.
that often we have seen
Sure.
that happened in crypto, that happens a lot
Sure.
of the time, right? And where
Absolutely.
we're losing our patience. And also like what we discussed earlier, think from a bit of a long-term perspective, not like I want to be rich overnight, like that, because that's
Not going to
probably
happen.
that's not going to happen, right?
Right.
And also the other thing that I wanted to talk about, you brought about like the people who are in their, let's say, worked for quite a few years now, 5-7 years maybe, who are in their, let's say, late 20s or early 30s, maybe somebody who's looking at getting married or so on and so forth. So for the people in a relationship or just getting married and stuff like that, how do you see that sort of dynamics between a couple? Any suggestions there on managing money as a couple? Like what works? Like, do you think both of them separately do manage their wealth, or both of them like do a combined wealth management? Any thoughts there?
I think, what I really like about finance is it's an art. It's not a science. A.R. Rahman creates music completely differently from how Preetham does, but both of them work. So I think it's more about, it's more like relationship. What works for you, what works is what works for you. It's similar with finance. Now some people are very, I would say, independent in the sense that they view their finances in a certain way and want to act on their own. some consider this independence as a sign of not being close enough in a relationship and being too protective about their money. So I think what see ultimately, what's more important is that money shouldn't hamper your relationship. I think relationship takes prominence here,
Yeah.
and then whatever works for you doesn't hamper your relationship. Probably, uh, you could either of the spouse could completely handle
Hmm.
it, do it the way they want, or probably they could collectively hire an advisor and let them. I think what the bottom line is, no matter how you manage your money, it shouldn't impact the quality of your relationship.
Hmm.
If you are mentally, happy in a relationship, I'm sure you'll figure out many more ways to earn your second income and your third income. Whereas if this creates a friction, you won't be even be able to focus on your primary job. So I think this is very personal. In terms of providing stability to the family, I think this is not about saving or planning. I think that's still very personal. But in terms of one thing that I've noticed is, if both of them are working, the ideal scenario is one person is taking risks in his or her career, say joining a startup or starting your own, or switching roles, switching profiles, and one person has a
Stable.
really stable income.
Hmm.
I think that provides a good balance to the family and security to
Yeah.
the people you are dependent on.
Hmm.
That is one thing that's really important.
Hmm.
But who takes the decisions collectively, independently, I think it won't hamper much. It won't have drastic effects.
Hmm.
I think I can understand if you end up, unless you end up buying, two flats in the same building, that's really bad concentration of wealth. But apart from that, it shouldn't matter much.
Hmm. No, I really like the idea of one person being stable and the other person taking the risk. Then
Right.
you are essentially saving yourselves from
Hmm.
things going down the drain, right? So that is really
Hmm.
really great practical tip for somebody who's trying to make that sort of thing. I think I remember probably watching a movie, or maybe I don't know, whatever that was, like, um I think it was a movie where husband says that, hey, I want to leave job, I've been not happy or whatever, and then wife ends up doing the same thing, like,
Oh.
and I don't know if it was a movie or stuff like that. So essentially, like, it's also about understanding and having that communication
Sure.
on probably saying that, hey, you know what, right now I want to take this risk and I want you to support me here.
Correct.
And maybe, like, hey, now I think that I'm a bit stable, maybe
Hmm.
probably then you can now go and take a risk. I think
Right.
that planning is very, very important. Having that
Right.
conversation
Right.
without feeling that, hey, you know what,
Hmm.
I'm really uh, giving a lot in this
Sure.
relationship. Like, you just can have that conversation and probably that can help. So that
Sure.
that I think is a great
Right.
way to look at it, right? So we let's so one of the things that we see today, a lot of our education on finance is coming from the influence that we have on social media, the
Mm-hmm.
finance influencers talking about you should be part of the share economy, don't
Mm-hmm.
buy car, don't buy real estate,
Mm-hmm.
that's really bad, or
Mm-hmm.
whatever, like invest, download this app or the other, or invest in this is fancy, and so on and so forth, right? So there's a lot of, while if we look at from much wider perspective,
Mm-hmm.
the general education on finance has improved to a certain level, yet also the chaos and confusion,
Oh,
there
absolutely.
has never been this kind of chaos or confusion, because then people never bothered about it, right? So while people are starting to think about it,
Mm-hmm.
and it's way confusing, right?
Mm-hmm.
So what are some of the like resources, or what are some of the starting points that you would recommend for people to start learning about the things?
Right. Hmm. So yeah, I mean, what you said is absolutely right, and I think it's more like business news channels, in the
Mm.
sense that most news channels are 24/7, and just that compulsion of showing something 24/7 in a way ensures that the quality cannot be good.
Mm.
It's you're choosing to to enter into something which by structure will not allow you to put out quality content. I think uh, in a lot of cases influencers assume or take that burden onto themselves, that one piece of content every day.
Mm.
Now that pressure that they've put on themselves, I don't know how much of that is actually because of way the algo works versus how much they think how the algo works.
Mm.
But they put that pressure on themselves, and once that pressure is there, one piece of content every day, they'll have to talk about fancy things. They'll have to talk about something that shocks the viewer every day, so that they retain that, uh, they ensure that the audience keeps coming back to them, because I think I talk about I make one video every 10-15 days, and it's not that I don't want to. I don't end up finding anything worth sharing
Mm.
more than once in 10-15 days, specifically because I've been doing that for the last 4 years, so I've said already a lot of things. So I can understand someone making a piece of content every day, what kind of pressure they feel. So I think I think ultimately, including me, all of us, on most of us on YouTube, on social media, more than finance experts, we are entertainers in a
Mm.
lot of ways.
Mm.
No one has a lot of proven track record of making or
Wealth.
managing public money. No
True.
one has that.
True.
It's just that we reproduce knowledge that assumed to be boring in a
Mm.
more entertaining and in a more bite-sized way. That's our role.
Mm.
Basically, and as long as people take us like that we could be a very good starting point.
Mm.
We tell you about something you did not know exist.
And then go and find your own
Exactly.
rabbit hole and go deeper
You
and do
don't
your
take
research.
your financial decisions based on what we say.
Mm.
One, we are not qualified enough, we are not experienced enough, we don't have that track record. To be very honest, if I was managing 10,000 crore rupees today, I wouldn't be on YouTube.
Mm.
I would be managing that money. That's brutally honest, but and I think that's true for 99% of the influencers I know. And I'm not saying they're doing the wrong thing. I think we have still played a huge role in increasing financial inclusion.
Yeah.
But when you start, whether the fault is ours or theirs, I don't know, when we try to portray that you can take actual serious financial decisions based on what we say, we are wrong. Or if you assume that whatever we say you go and buy, you are wrong. The
Mm.
audience is wrong. So I think one great way to start learning about money is Rich Dad Poor Dad.
Mm.
It forever it will drill the concept of money in your head. And the second is Learn to Earn by Peter Lynch.
Mm.
So start with these two books. uh in case of Peter Lynch, he's someone who probably has the best track record of managing a mutual fund. For 30 years he managed a CAGR of 30%. He was managing billions of dollars. He has no incentive to write a book for the purpose of earning few extra
Mm.
bucks.
True.
That's not the purpose.
Mm.
When I write a book, when someone writes a book or creates a new video, probably the incentive could be to earn a little more.
True.
But for him, that's not the incentive. So follow people you are sure that they don't have any vested interest in directly pitching you something.
Mm.
Probably the pie is too small for them, or they've already retired and made enough. So if Warren Buffett writes a letter,
Yeah.
he has no interest in trying to misguide you.
True.
He'll gain nothing. Fifth, sixth richest person on earth.
Mm.
Why would he write something wrong and put his reputation at stake? When Ratan Tata advises something, when a political leader advises something, you might think twice.
Mm.
There must be vote bank politics behind it. But when Ratan Tata says something about life or finance, why would he lie? Why would he say something wrong?
Mm.
And can I buy him? I can't. No one can. No company can. So you cannot make him say the wrong thing by giving him money. Can you make me say the wrong thing by giving me money? You don't know. So selecting your sources carefully, but to start with, Rich Dad Poor Dad and Learn to Earn.
First, thanks for being so honest about this. And but like you said, in raising the general awareness and talking about the things that probably you wouldn't have thought of, the whole the creators who are creating content are definitely playing like some really important role there. But like you said, take ideas from there, but then go deeper and
Absolutely.
find the people or the sources where you can learn a real stuff about it rather than just taking decisions based on a reel that you watched.
Another simple hack would be, say, if you think buy now, pay later cards are good.
Yeah.
If because of influencers are saying it or
Yeah.
advertisers,
Pay in 3 months.
you would ask, why did Axis Bank or HDFC Bank or ICICI Bank doesn't have a buy now, pay later card? These are pioneers. They have been innovating in the banking space in the last 30 years. If buy now, pay later was not just a fad and something real, Axis or HDFC or ICICI would have been the first ones to bring those cards out.
Yeah.
Why, when we talk about investing in US stocks, Zerodha doesn't offer that. India's number one broker, trusted, good reputation, good track record of being in compliance with the regulatory requirements. How could Zerodha miss offering US stocks? They haven't missed it. They have intentionally chosen not to build it. Why? There must be something regulatory problem. Why, when we talk about crypto apps, suddenly these Coinbase and Vault and all these companies were those who did not have a track record? Why? Why did no reputed entity start a crypto app? There must be something they were fearing. And if they are fearing, who understand financial market, banks and brokers, they understand financial market way more than we do. Why are we not cautious when they are cautious? So I think any product which you find that Zerodha, HDFC, ICICI or Axis is not offering is probably not a good financial product.
That's an interesting way to look at it, right? That was really great. So let's say if you, and I'm gonna give you a case, right? So let's say you were just starting your financial journey, where let's say you've just started making money and you've taken care of some basic stuff. You've done the fancy phone that you wanted to buy or whatever that you wanted to buy, and you were like, oh, now now probably I need to look at probably saving for later, maybe for 5 or 10 years and stuff like that. Now you're thinking about those things with the knowledge that you have today, and if you're just starting out on the whole idea of investing and saving and so on and so forth, what are the first few, maybe you can talk about like the safety nets, and then what are the basic things that I'll first take care of, and then if I still have more, then this is what I'll do.
So we need to bifurcate here that most of us are worried about what happens if we don't earn. So you first plan your investments around the situation when or if you are not earning. So what are those what could be those circumstances? One, after you retire, what will happen? How will you take care of your after retirement expenses? That's a problem. You buy a national pension scheme for that. So that's a blinder. There are a lot of retirement calculators. You put in a certain parameters and it tells you what amount you need to invest in NPS, and you start investing in national pension scheme. Absolute no-brainer. What other circumstances could be? Death. If God forbid you die, what will happen to your family? So you buy a life insurance. What next? What if you become really, really ill?
Okay, before on the life, like what about the term insurance?
Oh, all you buy is pure term life. So you buy till the age you think your children will become independent. So if you're 30, planning to have children in the next 5 years, you buy life insurance till the time you will be 65. By the time your children will be 30, most probably they'll be able to earn.
So you're saying term insurance?
Oh, absolutely term insurance, nothing else.
Okay.
Any other kind of life insurance is mis-selling. All you buy is term insurance, is very, very cheap. What we end up doing is
we're looking for return in the insurance as well.
Either that, or we are looking to cover ourselves for 80 years, 90 years. And by that time, your family will already be independent. You will not have any dependents. So if that's the case, you buy life insurance till the time you think your children will attain the age of 30. You don't, because then the premium really rises. Because for the insurance company also the risk rises.
Yeah.
They covering you for 65 versus they covering you for 75 makes a huge
difference. True.
So you save that money in your premium and you invest that in mutual funds and enjoy that right now. That
pension insurance.
Yeah.
Yeah. Third one.
Next is, what if you become seriously ill? So you buy health insurance for that.
Mm.
So that's the third thing. Fourth, and health insurance is something you buy for the entire family, because
Mhm.
anyone can fall
Yeah.
ill and you are the earning member, you're going to bear the financial burden.
Yeah.
So health insurance, entire family. Life insurance, only the earning member.
Mm.
Fourth is, what if you're laid off?
Mhm.
So you keep 8 to 10 months of emergency fund.
Mhm.
And now you
And
have
where do you keep this? Like in your liquid fund? Where do you put
liquid
them?
fund could work, or savings account with an auto sweep activated. So what auto sweep does is it gives you the returns of an FD
Mm.
and it retains the flexibility of a savings account.
Got it.
So that. So now we have covered most scenarios where you are not earning.
Mm.
Now once that is sorted is when you think about gold, real estate and stocks.
Mm. I think that's a good framework for everybody who's listening, because what I've seen is a lot of people have invested on
Mhm.
mutual funds and cryptos and whatnot of the world, that this fundamental is not covered, right? And
Correct.
which I think is such a wrong way to go about it,
Oh,
because you haven't
absolutely.
safeguarded the worst that can happen. You
Right.
haven't built the safety net and you went to
Sure.
invest.
Right.
Yeah. All right. This has been such a great conversation. Any parting words that you would like to share with the people who are listening to this conversation?
I've covered this, but I would say this again. No matter how much I say, it's never enough. Please don't invest in anything you don't feel comfortable with, because in the short run, it might offer you higher returns,
Mm.
but you will never be able to stay invested. You'll never be able to allocate enough capital, and in the long run, you will feel it was better off if I would have invested in this asset class where I felt comfortable investing more. It's about giving more time and investing more. It's never about getting more returns.
Thank you so much,
Yeah.
Pranjal, for
Pleasure.
sharing some really, really interesting perspectives. There were some, perspectives that I haven't paid attention to. So thank you so much for bringing that in notice and for sharing and being, authentic and honest about, a few things that was, really, really, uh, that was really, really helpful. And I hope there's a lot for someone who's listening to this to take from this conversation.
Thank you. Pleasure. Thank you so much for inviting me.
Awesome. Yes.
Done?
Yes, sir.